Okay, we'll start back with problem 21-4A. Again, that's on page 1019 in your book. If you're using a large book, it's PR 4A in the budgeting chapter, and I believe that's chapter 6 for you guys using the smaller book. So we took care of the first little section, estimated cash receipts from. Now let's go to estimated cash payments for. Manufacturing costs are the first thing they mention. And if you come down to the third sentence of the first paragraph, that tells depreciation, insurance, and property tax expense represent $3,500 of the estimated monthly manufacturing costs. The annual insurance premium is paid in September, so no cash going out this quarter, May, June, and July, for our annual insurance premiums. Annual property taxes are paid in November, so no cash outlay in May, June, or July for our annual property taxes. And remember, depreciation never requires a cash outlay. Of the remainder of the manufacturing cost, 80% are expected to be paid in the month in which they are incurred, and the balance in the following month. Okay, so let's come down to the second paragraph, 1, 2, 3, 4 rows down. They say current liabilities as of May 1st include $6,000 of accounts payable incurred in April for manufacturing cost. Okay, that's the other 20% left over from April's manufacturing costs. 80% of those would have been paid in April, the month in which they were incurred. The other 20% would carry forward in accounts payable and get paid in May. So that $6,000 is the other 20%. So let's go to our schedule here. Paid in May, incurred in April. Here's what we want. Paid in May, incurred in April, $6,000. Okay, paid in May and incurred in May. Okay, so we've got $34,000 will be total manufacturing cost for May, minus the $3,500 that represents monthly depreciation, insurance, and property tax that requires no cash outlay in May, June, or July. So that $3,500 needs to be subtracted out. 80% of that will get paid in May. $24,400. Now we'll add those two together. We get $30,400. Okay, now paid in June, incurred in May. Okay. Well, manufacturing costs for the month of May were equal to $34,000 minus the $3,500 incurred that represents property tax, insurance, and depreciation, none of which require cash outlay in May, June, or July, times 20% would get the amount paid in June. Okay, then June manufacturing costs were $39,000 minus the $3,500. For depreciation, property tax, and insurance that either gets paid in another month or requires no cash outlay. 80% of that number will get paid in June. So that's equal to $35,500 times times our 80% to 28,400. So manufacturing costs paid in cash in June, 34,500. All right, cost incurred in June was the 39,000 minus the 3,500, or 35,500, 20% of which would be paid in the month of July. Okay, and then July's manufacturing cost for 44,000 minus the 3,500 non-cash expenses for May, June, and July gets us to 40,500, 80% of which would be paid in the month of July. It's 32,400. So 39,500. Now we want to move these three numbers up to our main budget. We got 30,400 for May. Now let's look for June. For June, we have 34,500. And then for July, we got 39,500. Okay. Now you're finished with the difficult part. Let's knock out the rest. Selling and administrative expenses. See, they tell us about those if you come up 1, 2, 3, 4 rows from the bottom of the second paragraph. 4 rows from the bottom of the second paragraph. They tell us all selling and administrative expenses are paid in cash in the period they are incurred. That makes this one easy. We just pick up the numbers from the chart. 15,000 for May. Paid in cash in the period incurred. No calculations here. 15,000 for May. 16,000 for June. And then July, 22,000. Capital expenditures. We only have those in 1 month, and you guys, capital expenditures is just another way of saying purchases of property, plant, and equipment, or purchases of fixed assets. 80,000 in July. All right, cash payments for other purposes. Income taxes. 1, 2, 3 rows from the bottom of the second paragraph. It says an estimated income tax payment of 14,000 will be made in June. Okay, dividends. Sonoma's regular quarterly dividend of 5,000 is expected to be declared in June and paid in July. So we're going to pay a dividend in July of $5,000. So total cash payments, this is just our total from the second section here, estimated cash payments for. And we'll get a total for each of the 3 months. Okay, now, to get our amount of expected cash increase or decrease, we're going to take total cash receipts and subtract total cash payments. Total cash receipts, $84,780, minus total cash payments, $64,500. Gets you $20,280, and estimated cash receipts $89,420 minus $146,500 gets us a negative $57,080 in July. That's what we're looking to avoid. But as long as we know that on May 1st, we can still avoid it. Okay, cash balance at the beginning of the month. Go to the second paragraph, first sentence. It says current assets as of May 1st include cash of $33,000. Well, that's the cash balance at the beginning of May. Okay, now we'll add that to the amount of the increase. So the increase plus the balance at the beginning of May gets us the balance at the end of May. Cash balance at the end of May, $64,600. Cash at the end of May becomes cash at the beginning of June, $64,600. Okay, now we want to add these two together. The increase for the month of June plus the cash balance at the beginning of June gets us to $84,880. Cash balance at the end of June becomes cash balance at the beginning of July, $84,880. Okay, and that equals this one plus the negative $57,080. So it's a balance of $27,800, positive cash balance at the end of July still. But please notice, last sentence, second paragraph, management desires to maintain a minimum cash balance of $30,000. So we need to subtract that out each month to make sure we're not dropping below that minimum. So this one equals our cash balance at the end of the month minus the minimum cash balance. So we have $34,600 excess cash at the end of May. Then we've got $84,880 minus the $30,000. Excess cash of $54,880 at the end of June. And we have a deficiency of $2,200 at the end of July. Okay. Now number 2 says, on the basis of the cash budget prepared in part 1, what recommendations should be made to the controller? Well, you guys, we could invest some of this excess cash at the end of May or end of June, possibly earn a return, and wipe out this $2,200. We could also, let's look and see what's causing this. We have cash payments way more than our normal month, $146,500. Probably still need to pay the dividend that month. We could spread these capital expenditures over, say, 3 months and take care of it there. I'm going to say that's our best bet. If we could spread this $80,000 over, 4 months, then it would be $20,000 coming out each month, and we'd be fine. here for sure. Okay, what else? They could also notice in the first sentence of the second paragraph, they own marketable securities of 40,000. You guys, those could be sold to make up for any deficiency as well. So those are a few options that they would have. Maybe they could delay the payment of the dividend. They could for sure spread this, or I would think they could spread this capital expenditures payment of 80,000 maybe over 4 months at 20,000 each, or a little more than that each if we take into account interest. Or we could sell some marketable securities. Either way, we won't be deficient in July if we do that. Now, that minimum cash balance might be a big deal if we have a line of credit with a bank and they require us to keep a minimum cash balance. If we fell behind that or fell below that, they could call the entire line of credit. So that can be, that minimum cash balance, a very important thing. Alright, you guys, if you have any questions with that one or any of the other problems we've been working, please be in touch. Thanks a lot, and I hope you have a great day.